All right, let's talk about the Fed and the aftermath, right? Obviously, there was the palace intrigue that maybe is the biggest story there. I just talked with Ed Yardeni about the impact on markets. We went down and we haven't come back just yet, right? And Powell's fixation on tariffs I thought was pretty intriguing. He mentioned AI, and I can't remember him really talking about AI. Although I will tell you, overall, he did misdiagnose some parts of the economy when he talked about jobs. It was interesting, he downplayed the 92,000 drop in payroll because he said 80,000 was attributed to weather and strikes, but according to weather models, actually, if you take that into account, the number would have been down 151,000. All right, so I just kind of got the sense that Powell came out with the intention of maybe putting a chess move on President Trump and then kind of flying by, just kind of chilling out for the rest of the whole thing. Let's bring in SMBC America's chief economist, Joe Lavorgna. And Joe, you know, before I even get with that, so we had a really strong Philly Fed number today, another good and strong manufacturing number. There it is on the board. Not only is the numbers going in the right direction, we had a little bit of blip in the in prices, but prices are trending lower as well. And I know that you've been a strong advocate. The economy was firing on all cylinders before the Iran conflict. So I guess the big question is, how long would it take us to get back on track at the conclusion of the Iran conflict?
You've got, Charles, very strong pro-growth policies, from a permanency of the corporate tax changes, individual tax changes, the full expensing of CapEx, and most important, the full expensing for structures that will only last for 3 years, but will be extraordinarily supportive of the economy and underlying growth, and it's exactly in line with what President Trump wants in terms of industrial rejuvenation and reindustrialization itself. But as you mentioned, the big problem now is oil and gas, which effectively crushes household tax cash flow almost immediately because people can't transition, they don't economize, at least initially. Middle and lower class Americans can't.
Right.
They're stuck. Question is the speed and the duration of the oil and gas price move. There hasn't been that much damage yet, but there will be, and if it continues, certainly the growth prospects, which to start the year were excellent. Fundamentals have been solid. Secretary Bessent's highlighted that many times, but we need to get gas and oil prices back down. They were trending in the right direction. They were at a 4.5-year low a month or so ago.
Right. I mean, it was one of the biggest stories out there, one of the biggest positive stories. I read where you said the current situation is more complex than Liberation Day, because I think a lot of people are looking for, okay, it's over, snap back.
Right. Well, the reason I say it's more complex is that it's a different, this is literally matters of life and death. Trade was clearly important. The president's approach generally is to be very maximalist and then kind of move back to the middle, kind of stuff he's talked about in Art of the Deal. And there's certainly an incentive for our trading partners to deal with us. We've got the leverage, biggest economy, most important marginal consumer. This time around, you know, we're partnering with Israel, so we've got a partner in this effectively. And you've got Iran, who is now involved in this conflict with us. And what's happening, Charles, is it's not just us saying, okay, we can just maybe back away. There's a lot more involved. There's diplomacy.
Right.
Unfortunately, there's it's a war.
Right.
And that just doesn't make it like, okay, we could just maybe just leave, or it's just very deep. It's a different situation. And the reason I say complexity is it seems like when I talk to investors, many people are using this playbook, but the president's just going to like, okay, that's it, we're done, and then it's going to go back to normal. And maybe that's too optimistic.
What's your take on jobs? I had yesterday Art Laffer on, and he talked about the adjustments with the migration, and we need fewer jobs. And then yesterday, Powell suggested that maybe zero net jobs.
That doesn't make any sense.
He said that maybe that's okay. Maybe our economy doesn't need jobs.
No, I don't believe that. I mean, if you look at the data, Charles, what you saw is the labor market starting to weaken in 2023 under the prior administration, and it really started to soften by late 23. We had almost about 2 million downward revisions to jobs. So when the new administration came in, you look at the revised data, we were clearly on a much lower glide path. We've basically been kind of stalling out. I'd argue the president's tax and regulatory policies are very positive.
How many jobs do we need? What's like a minimum number? It's lower than it used to be. It's like, could 50,000 be considered a positive?
I mean, I don't see how 50,000 could be the number when one standard deviation on the monthly payroll miss is closer to 100,000.
Right.
So that doesn't make sense to me. No, I think maybe 125, 150,000. And look, the Fed would be cutting interest rates. Governor Waller's made some great points on why rates should be lower based on risks to the labor market. But right now, with inflation where it is, and reasons I lay out, the fundamentals are still pretty solid.
Right.
The Fed's going to sit and do nothing. They don't want to take the chance to ease, to offset the supply shock, to cause inflation expectations to become unanchored.
And to your point, Waller was not at dissent yesterday, right? He had dissented the meeting before. I got a minute to go. I want to ask about AI or AI optimism. I heard Powell talk about it a little bit more than normal. Greg Ip had this part where if you look at this, the economic projections, the long run projections from December went to 2.0 from 1.8, and he suggested maybe that's AI starting to contribute to productivity and to the economy.
We saw productivity start to improve noticeably in the first Trump administration, and then following the pandemic, it stayed relatively high. The growth rate reaccelerated. We've seen so far in 2026, very low unit labor costs because productivity's been so high. To me, the Fed is way too pessimistic, saying only 2%. I don't know why they're not higher on potential, closer to 3%.
Yeah.
This is the argument I think the President administration has made. I think is very valid. But I mean, I don't know how much of it's AI. They're looking at it as like, look, we've got a strong economy, productivity is accelerating, you're increasing the potential capacity of the economy. This is all good for worker wages. But again, Charles, it's all getting caught up in the oil and gas move, which is a risk to the outlooks, a risk to the markets, is a risk to the economy.
Right.
So the sooner this ends, the better everybody's going to be.
Joe, it's good seeing you, my man.
Thank you, Charles.
Appreciate you. Thanks.